Fed warning, the end of an era for stocks. This is a friggin' great article by my man Michael Leibowitz over at, is he with Real Investment Advice? I think so. Jill sent this to me just a few minutes ago, actually, and I said, man, because a couple guys I read all the time. Leibowitz is one, Michael Edison is another over at Advisor Perspectives. Anything that, I haven't seen him writing for a long, long time. I've drawn a blank his name now, a tax guy. I can't remember. But Edison, Leibowitz is another guy, Real Investment Advice I like a lot. Blanchett, anything Blanchett writes, Wade Fowl, I'll read that. Who's the freaking Keebler? Bob Keebler. If Bob Keebler writes, I don't know if he's still alive. I haven't seen him around a long time. But anyway, let's dive into this. I'm back in my dungeon here, in the hostage video, not outside. Just FYI, in case you got bandaged. Yeah, I did again. I'm always getting bandaged. So here's my man Michael Leibowitz, something like that. Leibowitz, I guess. And is he with Real Investment Advice? I think he is. Yeah, Real Investment Advice right here. And I forgot the other guy's name from Real Investment Advice who writes a lot too. Just good stuff. These guys are crushing. I think they got a YouTube channel actually. I think this kind of grown pretty good lately. So good on them. Recent white paper by the Federal Reserve warned of significantly lower profit growth and stock return in the future. The coming long-run slowdown in corporate profit growth and stock return, says Michael Smolyansky. All right. Understanding why corporate profits and ultimately stock prices have outperformed in the past is important. But most critical for investors is the future, exactly, in assessing how interest rates and tax rates will affect earnings growth going forward. All right. This right here, look at this. The graph below, end of an era, paper summary, shows that corporate earnings have grown faster over the last 30 years. All right, so here are earnings in the orange, than the 40 years before. So here's earnings from 1947 to 1989. They grew at a nice, stealthy, good 7.24% clip from 1947 to 1989. That's good. Robust is probably a better word. And it increased from 7.76 to 7.76. So corporate earnings increased by 50 basis points over the last 30 years than they did over the last 40, which is interesting because GDP went down. GDP was average clocking in, and this is nominal GDP. GDP is clocking at 7.68. Nominal just means before inflation. To 4.68. We have a 300 basis point decline in GDP, basically halving almost, and a 50 basis point increase in corporate earnings. Well, how the hell is that happening? He identified two factors. All right. Interest rates and corporate tax rates both declined substantially. This had the mechanical effect of significantly boosting corporate profit growth. Specifically, I find that reduction in interest and corporate tax rate was responsible for 40% of the real corporate profits. 40%. So we take this off by 40, and we're going to get 7.76. 7.76 times 0.6. Oops. 7.7. Jeez Louise. 7.76 times 0.6. 4.65, which would be right there in line. Look at that. Almost perfect. And now, just because he's calculating doesn't mean it's like scientific or anything like that. But still, you can see here's a 10-year treasury right here. Look at that. Zoopsh. Zoop from 1980. Zoopish. Look at that. All right. Here's corporate leverage, how much debt they're taking on. Zoops. Debt to total assets. Zoop, zoops. And so, isn't that interesting? So again, he finds that reduction in interest and corporate tax rate was responsible for 40% of the growth in real corporate profits. Now, again, that's almost too clean if you ask me. So if you had a 4.65% corporate growth, 4.68% GDP. So basically he's saying, well, the corporate growth shouldn't have grown that much because GDP was down here. Thus, the only thing it'd be attributed to is what? We're going to search for something to cause that, which is low interest rates and low taxes. But I get what he's saying, and probably some truth to that. By 1989, the effective tax rate on corporations stood at 34%, having fallen from an average of 44% from 1962 to 1982. From 89 to 2007, effective corporate tax rates averaged 32%. Then they drifted lower, and here we are today. Effective corporate tax rate. Remember, effective tax rate and marginal tax are different. Effective is how much total tax you pay on your earnings. That's effective. Marginal tax rate is different. We're not talking about corporate tax percentages, tax rates. We're talking about marginal tax rates. We're talking about effective corporate tax rate. So for every $100 a corporation nets, they're only paying 10%, $10 to taxes. All right, so here's my man Michael Leibowitz. To illustrate the benefits of lower taxes and low interest rates, I calculated how they helped improve profits for 3 well-known companies. He's used McDonald's, Pepsi, and Clorox. Lower interest rates and lower tax rates had meaningful impact on earnings, as shown by below. Michael Smolinski's estimate that interest rates and tax boosted earnings by about 40% in aggregate is in the ballpark, according to Michael Leibowitz. Check this out. In the 1990s, McDonald's had $6.5 billion of liability. In 2022, they had $56.5 billion of liabilities. They increased their liabilities by 770%. All right. In 1990, they paid $381 billion. Is that billion? Yeah, I guess $1 billion and I don't know, it says billions. $1 billion of interest expense. In 2022, they paid $1.2 billion of interest expense. So they increased their liabilities by 770%, but they only increased their interest expense by 217%. With Clorox, Pepsi increased their liabilities by 512%. Their interest expense only went up by 36%. Clorox increased their liabilities by 563%, but their interest expense went up by 276%. But look at that. Pepsi, I mean, it's nuts. Talk about leverage. Talk about freaking arbitrage. Effective interest rate, McDonald's was 5.88, now it's 2.14. Pepsi is 5.63, and now it's 1.25. 3.45 to Clorox, 1.95 now. Tax rate declined for McDonald's by almost 15%. Pepsi almost 20%. Clorox almost 15% there too. Look at that. Net income, $6.1 billion, $8.9 billion, and $462 million, I guess. Yeah, $4 million. Net income using 1990 tax rates, 2.9, 3.6, 290. Percent income due to lower tax rates. 52% of McDonald's earnings are due solely to lower tax rates and lower interest rates. 59% of Pepsi's income, net income, is due to that. 37% of Clorox's is due to that. That's nuts, man. So here you can see McDonald's interest and tax rates. And right here we got the effective interest rate, 5.88 to 2.14. Effective tax rate, 35 to 21. Pepsi, same thing. Clorox, same thing. While lower interest and tax rates boosted growth significantly, the ability for it to continue is negligible. The end of a rewarding era for stocks is likely behind us. I've been saying this for years. So I just got off the horn with the guy today. This guy and his wife crushed out in Florida. Talked to 2 people in Florida today. Anyway, he's sitting on about half his portfolios in cash and half in stocks. It's kind of like me. He's like, look, man, I'm getting rewarded 5% for a Schwab money market account. I just don't see how the markets can continue on this trajectory. I just don't get it. I 100% agree. Where's the earnings growth come from? Technology. That's like the solar power people. When are we going to get solar? When we have the batteries. Well, why don't we wait till we have the batteries before we mandate everybody go solar or electric vehicles and stuff? It's stupid. Same kind of thing here. Technology, that will give us a corporate earnings boost. Where? How? When? AI? AI is, really? Is that really going to give us a corporate earnings growth? AI, technology, kind of like battery power. Are we really going to have batteries to run the economy? No. I mean, maybe, but let's see it happen before we freaking put all our money in stocks, assuming that's going to happen. Let's see how it can happen before we spend, $6 trillion over green stuff, and we still can't freaking power an economy on wind and solar. It's not even close. It's not even close. Anyway. Given that federal deficits will continue to grow faster than the economy, it becomes increasingly unlikely that the government can afford to reduce corporate tax rates. I completely agree. In fact, the odds favor raising taxes. Interest rates may fall back to the low levels of the last 10 years, but unless rates go negative, there's little room on the margin for corporations to reduce their effective interest rates. Consequently, corporate growth and profit in the aggregate will be closer to GDP in the future. If it's closer to GDP in the future, and the GDP is here, I guess that's a high GDP too. Guess what happens? Corporate growth is lower. Dividends are lower. What does that do for stocks? Remember, stocks are always and everywhere. I'm going to show you on this. I'm going to bring you over here to my whiteboard, and I'm going to show you. Oops, I just knocked something out. And let's see if I can't do this while I got this. All right. Earning rate of return equals. Ready? Equals year over year profit, or we say earnings growth, I should say earnings growth. Year-over-year earnings growth. Now, this is some first-class freaking YouTube stuff here, isn't it? Year-over-year EG plus dividend yield. All right. Again, expected rate of return equals year-over-year earnings growth plus dividend yield. That's it. That's it, baby. Hey, I did it. I thought I might do that on my tongue. I was trying to smell that thing, see if they had a good smell to it. No, they don't. They don't. You don't get high on that either, by the way, just FYI. All right, so earnings growth plus dividend yield is your corporate profits. That's your rate of return on stocks. That's it. Where does the earnings growth come from? All right. Consequently, corporate profits will be close to GDP in the future rates. The gap between GDP and profits I highlighted at the article's opening will likely close 100%. Profit growth of approximately 4% isn't bad, but high valuations are predicated on solid profit growth, a hell of a lot more than 4%. GDP-like growth is not forecasted exactly, and will likely weigh on stock prices. Simply put, investors will not be willing to pay an above-average valuation for below-average profit growth. Again, let's go back to the chart here. So I'm going to show you something else here. All right, what's the wild card in this formula? What's the wild card in that formula right there? Is PE expansion or contraction? Look at that. I'm crushing today. PE expansion or contraction? PE, what the price someone's willing to pay for $1 of earnings. Are you going to be more inclined to pay high for $1 of earnings when the interest rates are high and the corporate profits are low, or you'd be less inclined to pay high for $1 of earnings when interest rates are high and corporate profits are low? You're going to be less likely to pay for that, 100%. So that would be PE contraction. So we got low earnings growth year over year. Why? Because we just said interest rates are low. Tax rates will probably start creeping back up. Dividend yields aren't anything to be yelling about. I mean, the dividend yields are low, 1.5% to 2%. And then we got PE contraction. I'm just telling you, man. So the guys just working with today said, look, I'm giving you a 4.6% rate of return with a standard deviation, downside risk, similar to what we had in 2008. And you're still coming out with flying colors. Why? Because they don't have any debt. Oh, my goodness, no debt. Who'd have thought it? Who'd have thought it? Anyway, great article by my man Leibowitz. Let's see what else he says here. The tailwinds of the last 30 years propelling profit by about 3% more than GDP are likely over. 100% agree. Without some help, profits will track nominal GDP, but higher interest rates and tax rates are not out of the question. Profit growth of 4% may be on the upside, 100%, with meaningful downside if interest rates stay around current levels or tax rates increase. Yep, 100%. Do we have any comments on here? Let's see what we got here. You made me feel. No comments. What? People don't want to hear that. No comments. Wow. One of the best articles I've read in a while. I've read in a while. Vogel would nod his head in complete agreement. All right. Anyway, so there you go, my friends. I get it. You guys, we want to be there for the stocks for the long run, but look, that doesn't mean there's gonna be a recession, crash, all this stuff. I'm just saying that at the end of the day, man, take some gains while the market gives them to you because they might not be there for long. Love your thoughts. If you like what we're doing on this YouTube video and you want to help me out, buy me a cup of coffee. It's in Doobie Dook. Don't forget to subscribe to my email list, and my locals channel is all down below too. We'll see you guys. Thanks now.